Today we are going to discuss chapter 9, the analysis of a competitive market. We in this particular chapter we use the tools of consumer surplus and producer surplus in order to evaluate price control, quantity control, or any type of a measure that is putting a restriction on the market to adjust accordingly and set a market price and the equilibrium quantity. So if there is any intervention either from the government or in any way that the competitive market is not behaving freely, if there is any interference, that interference either in the shape of a price control or a quantity control, that creates a distortion in the market, and we will analyze with the help of a consumer surplus or the producer surplus to see what is an impact of these controls. So let's start. Supply and demand analysis to show how it can be applied to a variety of problems, including situations in which the first situation we're going to talk about, a consumer faced with a purchasing decision. The second type of situation we want to talk about, a firm faced with a long-range planning problem, and the government agency that has to design a policy and evaluate its likely impact. So we are using the supply and demand framework to calculate the consumer or producer surplus and see what is the impact in these situations. So consumer and producer surpluses to demonstrate the efficiency of a competitive market. So we want to analyze a competitive market. If a competitive market is free to behave, there is no restrictions. So then the ideal situation is that the demand and supply intersect at a point where there is a equilibrium or a market clearing price. And we see here in this particular diagram or a graph that the equilibrium price is 5 and the quantity is QC, or we can say that that's the price, the equilibrium quantity or equilibrium. The consumers, we want to find out the consumer surplus at this price. So as we all know that consumer surplus is a willingness to pay by the consumer and the price. The difference between the willingness to pay and the price is consumer surplus. Geometrically, we can calculate the consumer surplus, all the area below the demand curve and above the price line. The price line is this. So we can see that this yellow shaded area is a consumer surplus. So if this is the consumer surplus, how we can measure this area? We all know that right angle triangle, a triangle with a 90-degree angle, one of the angle is 90 degrees, called as a right angle triangle, and the area of a right angle triangle is measured base into height into 1/2, or base into height divided by 2. So we can see here. So we see here consumer A would pay 10 for a good whose market price is 5 and therefore enjoys a benefit of 5. So this is, we are just talking about a consumer A. So consumer A's willingness to pay is $10, but he is actually paying $5 because the market price is 5. So the $5 difference is the consumer surplus for consumer A. Consumer B's willingness to pay is $7, but he is paying again the $5, which is the market price. So the consumer B's consumer surplus is only 2. So we see here the consumer C willingness is 5 and the market price is 5. So the consumer surplus is 0. And so consumer whose value at exactly the same market price enjoys no benefit. So consumer surplus, which measures the total benefit to all the consumers A, B, C, D, or whatever it is a yellow shaded area between the demand curve and the market price. Or this is a technical definition, area below the demand curve and above the price line is called as a consumer surplus. On the other hand, the producer surplus, if we look at the producer surplus is a more easy to understand concept because producer surplus is the marginal cost or the supply curve, marginal cost, and the difference between the price and the marginal cost is the producer surplus. So producer surplus measures the total profit of a producer plus rent to factor inputs. So it is the benefit that lower cost producers enjoy by selling at a market price shown by the green shaded area between the supply curve and the market price. So we see here this green shaded area, this one is our producer surplus, and we see producer surplus is again a right angle triangle, so we can apply the same formula like base into height into 1 by 2. So by this way we can calculate the area of a producer surplus as well. So we all know that in a society, if we want to calculate the total benefit to the society or the economy, so we have to calculate the consumer surplus as well as producer surplus, and all together the producer plus consumer is the total surplus to the society or the economy. So we see here that at the market equilibrium price of $5 and the market equilibrium quantity of Q0 here is the point where the producer and the consumer surplus is at its maximum. No other point. If you want to calculate any other price or the quantity at which you calculate the producer surplus or a consumer surplus, you will get the total surplus less. So if you set the price higher than the equilibrium, so there is a possibility that the producer surplus is more and consumer surplus is reduced, but the reduction in producer and consumer surplus is overall decreasing the total surplus to the economy, and that's what we call it as a deadweight loss. So we see here that evaluating the gains and losses from the government policies. So consumer and producer surplus. So consumer and producer surplus, we see if the government intervene in the competitive market and say, no, this price is not fair, and they try to set a price by themselves as a price floor or as a price ceiling. So we see here that if they set the price, like in this diagram, if you say the government said that the maximum price you can charge is Px max. So you see here P max. So P max is the price, the maximum the producer can charge. Now with this price, we can see that the consumer surplus is increased. Initially, the consumer surplus, if you look at very carefully, initially with this price P0, the consumer surplus is this triangle. Now by setting the price lower, so what is happening, that the consumer's surplus is increased by this rectangle A, but at the same time there is a reduction, and that's a reduction of a triangle B, because you see here this much. So consumer surplus is increased by rectangle A but reduced by B. So we can see very easily that A area is bigger than B, the lost area. So we can say that consumer is going to be better off. Why? Because the price is set below the equilibrium level, so the consumer is going to be better off. But at the same time, if you look at that the producer is losing the surplus by this, initially it was this, but they are losing the surplus of this trapezoid, right? Now this A rectangle is a loss to the producer, but it's a gain towards the consumer. So overall society has no impact. But at the same time, the C is going to be lost by the producer, and that is not getting by the consumer. So that's a loss. So overall, by setting a price by the government, that's a minimum price, favors the consumer, but overall the total surplus to the society or the economy is reduced by these two triangles, triangle B and triangle C. So triangle B is a reduction in the consumer surplus, and triangle C is the reduction in producer surplus plus rectangle A. But we are saying rectangle A has no impact on the total surplus because it's a gain, it's a loss to the producer, but it's a gain to the consumer. So overall that is not an impact. Now who is going to suffer more if the government set a price below the equilibrium price? So it depends on the elasticity. It's not like who is going to suffer more. So we can see here effect of a price control when the demand is inelastic. So if the demand is inelastic, the triangle B can be larger than triangle A, rectangle A. So in this case, the consumer suffers a net loss from the price control. So we can see there is a possibility that even the government set the price below the equilibrium price, but because the demand is inelastic, so there is a possibility that the consumer surplus is decreased. Now here is an example to understand this whole situation, the government policies intervention. So there is a price control and natural gas shortages. So natural gas, we all know that we need natural gas, especially in winter season, to heat up our houses, and everywhere we need gas. So there is always a situation of a shortage type of situation in winter. So here is a case like this is our supply curve of a natural gas. This P0 is an oil price, right? So because natural gas demand is dependent on price of oil as well. This is a demand function or a demand curve or demand equation for natural gas. This is a supply, this is a demand. QD demand, QS supply. So the market clearing price, like if the market is free, there is no intervention, there is no restriction. If the market is free, the market clearing price of a natural gas was $6.4 per the MCF or a metric cubic feet. That's this, and this price is 6.40. This one, you see this arrow, 6.40 is the hypothetical maximum allowable prices. Like if we assume that the government is setting the price at $3, so the market clearing price is 6.4. So definitely if we set the price, because we say that it is not fair that the consumer has to pay this much high price in the winter season, so we say no, that the price should be of a $3 per MCF. So we can calculate the shortage. And how we can calculate the shortage? We can easily plug in the values. Like when we equate these two, we get the market clearing price as 6.4. But if we plug in $3 in quantity supply, and again the $3 in quantity demanded, and there is an oil price is given there. So the oil price is both same in this situation. And when we find out the quantity supplied and quantity demanded and the $3 price, we see that the demand is 29.1 MCF and supply is 20.6. So there is a shortage of or a shortfall of 8.5 trillion cubic feet results. That's a total shortage. The gain to the consumer is rectangle A. Now we see that why there is a gain for a consumer, because the consumer is paying $3 instead of or in place of a $6.4. So this rectangle A, like what we discussed in our graph 1, this rectangle A is a gain to the consumer. However, there is a loss to the consumer as well. Like these consumers are not able to buy because their willingness is because there is no supply. Beyond that point, there is no supply, so they are not able to get. At this supply, there is a loss, that is A is a loss to the producer, as well as the C is the loss to the producer. But we see here the deadweight loss is the sum of the triangle B and C. B is a loss to the consumer and C is the loss to the producer. So we can find out, these values, we can get it very easily by plugging in the values into the equations. Like if I explain you that this is our equilibrium price, when we equate these two equations, 6.40, when we plug $3, so we can get it, this much is the quantity supplied and this much is the quantity demanded. sorry, at this price, we see here 20 point sorry 20.6 is the quantity supplied. But if we plug this value of $3, we see here that the quantity demanded is this much, which is 29.1 and 20.6. So we see here 8.6. So a rectangle, we can all find out these values, like this value, this value, this value. So a rectangle is the base of 20.6 into 3.40, because that's the height of this rectangle. So we see here there's a gain and towards the consumer, but this is again the loss to the producer as well. Now triangle B, which is 2.4 MCF into 1.3 MCF, so we get it 1.6, and C is a 4.08, and altogether when we add up, we get it 5.68 is a deadweight loss. So 5.68 is a deadweight loss because these are the two triangles. But what the here the annual change in the consumer surplus that results from this hypothetical price control would therefore be A minus B. So A is the total gain and B is the loss, so we subtract, so we get it this value. This is a gain towards the consumer. Now what is the loss to the producer? A and minus C, so minus 70 minus 4, so 74. Now if we find out the difference of these two, we get it 5.68. So that's gonna be same like what is the triangles. So economic efficiency, maximization of aggregate consumer and producer surplus. So economic efficiency for the society, for the economy, is that the consumer surplus and the producer surplus should be maximized. But we see that the maximization is not possible when the government intervene by setting the prices, or there is also a possibility of a market failure. Now, it is not necessary that every time the market is providing the best outcome. So there is a possibility that the market outcome is also not best for the economy. And the reason behind this failure or this worst outcome is there are two reasons. One is the externality and the other one is a lack of information. Now, what is an externality? Situation in which an unregulated competitive market is inefficient because prices fail to provide proper signals to consumers and producers, and there are two important instances in which the market failures can occur. One is externalities and the other one is lack of information. Now, what is externality? Externality is when two parties are doing a transaction or they are doing exchanges, but a bystander or a third party is going to be affected with that, which is not involved directly into that transaction, is called as an externality. Action taken by either a producer or a consumer which affects other producers or consumers but is not accounted for by the market price, that's called as an externality. So others are affecting which the market is not taking care of. Like if one person is smoking, so he's the buyer of a cigarette and the seller is the seller of the cigarette, but when they are smoking in the public is going to affect it, and the market is not counting that effect or that loss to the health of those who are standing nearby or close to the smoker. So that's the way that we can define externality. Market failures also occur when the consumer lack information about the quality or a nature of a product. In the stock market, many people lost their monies because it is quite close to the competitive market, but people are making decisions based on poor information, based on poor calculation. So by this way, they are making wrong decisions and they lost. And the reason behind their loss is lack of information or incomplete information or poor information. So that's also possible as the quality or the nature of a product, and so cannot make utility maximization purchasing decision. So government intervention, like we discussed, like price setting, price floor, price ceiling, these are also creating a problem. Requiring truth in labeling, and that's the reason that now the government forced that every product should be labeled, their ingredients quite in detail, or anything which has a negative impact, they have to very clearly mentioned on their packing and all these things. That's a requirement that in order to increase the information or as much as possible information to the consumer or a buyer. Now, efficiency of a competitive market, we just see in our previous two examples, like an example of a natural gas or just a hypothetical way. So we are repeating here, welfare loss when the price is held above market clearing price. So we just discussed in this scenario when the price is below the equilibrium, but what is the situation if the price is set above the market equilibrium price? So again, the same situation arises, like the market clearing price is 0, but the government say no, that's not fair with the producer, so they set the price P2. Now, if they set the price P2, you see the very similar type of diagram is appearing here. The only difference is that this rectangle is above the old one, and these two triangles are there always. So we see here when the price is set over the equilibrium price, that benefits the producer, and producer is getting a benefit of A, rectangle A. But at the same time, they are losing C, and the consumer is losing A and B. So ultimate, what is an impact is the same like what the price setting below the equilibrium. So for the society, overall impact is same whether the government is setting the price below the equilibrium or above the equilibrium. There is a deadweight loss, and the deadweight loss is equal to B and C. So when the price is regulated to be no lower than the P2, only Q3 will be demanded, and if Q3 is produced, the deadweight loss is given by the triangle B and C. So it's very similar, like in this case you see B and C, the deadweight loss when the price is set below the equilibrium. When the price is set above the equilibrium, again the same situation is there. Very practical example given here in this case, like when the price is set above the equilibrium or below the equilibrium, what is an impact? So here is an example, and that's a very sensitive example in a way that human kidney, the market for a human kidney. There are many cases of renal failure, and that type of problem of a health is resolved through transplantation or transplantation of a kidney, human kidney. So there is a demand for human kidneys because people are facing this problem of kidney failures. At the same time, there are some people who are ready to sell there, or ready to not sell, because sell is not an appropriate word. They are ready to donate their kidneys. Now, this is the market. The whole market is there because many thousands of people need that, and thousands of people are providing them. So even at a price of a 0, if we set, and this is by law that you cannot sell your kidneys, and that's under human consideration, it is not allowed that you can sell or anyone can sell the human parts or human body parts. So in that case, the price for yes, someone can donate it, but they cannot sell it. So even at the price of 0, because when you are donating, you are charging 0 price. Donors supply about 16,000 kidneys per year with a 0 price, just a donation. It has been estimated that 8,000 more kidneys would be supplied if the price were 20,000. So that's a calculation, and that's maybe through the data they generated, and they analyze that if there is a certain price like a $20,000 for a kidney, 8,000 more kidneys are in demand. We can fit a linear supply curve to this data. The supply curve of the kidney is Q is equal to A plus BX. So this is simple linear equation. So if P is 0 and Q is equal to 60,000, so we can say that A is 60,000. If P is 20,000, the Q is 24,000. So we can say, we can calculate this slope of the curve because it's a linear. We are assuming it's a linear equation, so we can get it. Here the slope is 0.4, and we write it this supply equation as 16,000 0 price plus any further they're going to provide it with the rate of 0.4. So note that the price of a 20,000, the elasticity of supply is 0.33. It is expected that the price of 20,000, the number of kidneys demanded would be 24,000 per year. So like supply, demand is relatively price inelastic. A reasonable estimate for the price elasticity of demand at 20,000 is 0.33. This implies the following linear demand function. So we can say that this is our linear demand function as well, like 32,000 minus 0.4p, that's a quantity demanded. When we draw the curves, so you see here, this is a demand curve, like a 32,000 kidneys are required at the price of 0, but only 16,000 at the price of 40. So this blue line is a demand curve. The supply curve is unique here. You see that there are two supply curves. One is upward sloping and the other one is vertical. This vertical supply reflects according to the law that no one can sell their kidneys. So by this way, there is only a supply of 60,000, and that is not dependent on the price because they're at a 0 price. But if we just, allow the supplier to charge price, then the supply curve should be like this. And based on this supply curve, we see that the equilibrium of this is at the price of 20,000 with the 24,000 kidney supplies. So the market clearing price is 20,000. At this price, about 24,000 kidneys per year would be supplied. The law effectively makes the price 0. About 16,000 kidneys per year are still donated. This constrained supply is shown by this curve, which is vertical. So the loss to the supplier to given by a rectangle A. So this is the loss to the supplier, and and triangle C. So this A and C is the loss to the supplier. If a consumer receives kidney at no cost, that gain would be given by the rectangle A less B. So this A is a gain and B is a lost. So we can say economics, the decimal science shows us that the human organs have an economic value that cannot be ignored, and prohibiting their sale impose a cost on the society that must be waged against the benefit. So we can calculate that there is a deadweight loss in this market. Because why there is a deadweight loss? Because by law we say that the trading of these human kidneys are not allowed. Here is a case we want to set minimum price when the price is regulated to be no lower than price minimum, like this. Here we see, so we see that this is the gain to the producer, this is the now what is happening here in actual. So producers would like to supply Q2 at this price. The producer is willing to produce Q2 because this is the supply curve. But the consumer is only buy Q3, this one. So we see here the supply is this much, and with this price, the demand is this much, right? We see here, right? If producer indeed produce Q2, the amount Q2 minus Q3 will go unsold, and the change in producer surplus will be A minus C minus D. In this case, the producer as a group may be worse off. So if we set the price high, and if they are not able to sell this much quantity, like D, this D shaded area, then the total change in consumer surplus is minus B minus A, this one, this total, this one. And the total change in producer surplus is A minus C minus D, which is quite big. And by this way, we say that this is not favorable. But normally when the price is set like this way, then the government has to buy this, and we will talk later on in the second part of this chapter. So the minimum price, although the market clearing price is W0, firms are not allowed to pay less than W minimum. So this result is an unemployment of an amount L2 minus L1 and the deadweight loss given by the triangle B and C. So that's again an example of our minimum wage, and we see that for the minimum wage there is a point of unemployment. So the book is also discussing another example, like an airlines regulations. So airlines normally are nowadays, it's going to be very competitive, but before 1981 most of the airlines are run through a very regulated type of industry. So airlines deregulation in 1991 led to a major change in the industry. Some airlines merged or went out of the business as new one entered. Although prices fell considerably to the benefit of a consumer, profit overall did not fall much. So effect on airlines regulation by the Civil Aeronautics Board. So there was a aeronautics board. Normally they control the prices and all these things, and that was abolished in 1981. And free sky or a free sky policy were adopted at that time. So at price P minimum, airlines would be only supply Q2. So you can see from this diagram they are only supplying Q2, well above the quantity Q1 that consumers were billing. So they are supplying Q2, and the price and the willingness to buy is only Q1. So that consumers will buy. So here the supply Q3 trapezoid D is the cost of unsold. So this is the unsold. And if you discuss with your parents, like before 1981 or in the early 19s, it was a very common thing that when you travel through an aeroplane, you can find a lot of very vacant seats. But nowadays there is no way, that very rarely, very few instances that you notice that few seats are vacant or empty, because these are the very perishable thing that airlines are selling. When the planes take off, the seats which are empty is going to be lost. So they lost. So we see that during that period when the prices are set by the aeronautics board, which is higher, and because of this higher prices, the airlines are supplying more seats available, but the consumers are buying less. So because of this, there is a unutilized capacity that is flying from here to there. So that's a wastage, or so trapezoid D can together exceeds the triangle A, which is a gain to the airlines. So in addition, consumer loss B, A and B. So this is the data from airlines, like because airlines have no control over oil prices, it is more informative to examine a corrected real cost index, which removes the effects of changing fuel costs. So we can see that over this period, like from 1975 to 2015, it's around a 40 years of period. We see how the airlines numbers increased over this period when the open skies policies were adopted. Passengers load factor is increasing to, passengers mile rate is increasing to, the real cost index is decreasing, and the real fuel cost index is also decreasing. The reason behind, there is no vacant seats fly, or less vacant seats fly. So the real cost is decreased over this period. So airlines profit margins. Following the re-regulation in 1980, new airlines erected and price competition becomes intense, so that profits are very low. So after 2000, profit margins increased as airlines merged and reduced seats capacity. So that's the way that, but we see that this is a very volatile market in profit making. We observed that during the COVID, many airlines suffered. Why? Because of a less traveling around the world. We also observed that after 9/11, the airlines also will get affected. So there are many scenarios in which the airline business is going to be very volatile. So this is all what we want to discuss in part 1. So stay tuned, and we see in a part 2. Thank you.